In this section, we're going to talk about accounting for short-term investments. Short-term investments are current assets. They're also called marketable securities. They're easily convertible into cash, and therefore they are shown right after cash under your current assets. They're the second most liquid asset after cash. And short-term investments are investments that we expect to be held for 1 year or less. Just by their definition, if we call it a short-term investment, we expect to hold that investment for 1 year or less. When we talk about marketable securities, we're talking about trading securities. These securities can be bought and sold on the open market. Typically, companies hold these for a short time and then sell them. The purpose of trading securities is to realize a profit. This is not guaranteed because if the market price of an investment decreases, a company can incur a loss. But typically what they want to see is the market price of an investment increasing, therefore resulting in a gain. Trading securities can be debt or equity securities of another company. Equity securities is stock. So if a company goes out and buys shares of Google on the open market, that would be a trading security, provided they plan to hold it for a short time and then sell it. When we're talking about debt, we're talking about bonds. And we'll talk about bonds later on during the semester. Trading securities can earn interest if it's a bond or dividends if it's a stock. And if they pay interest or dividend while you're holding that security, it is treated as interest revenue or dividend revenue. Remember, in accounting, we always look at it from the point of view of the company. And when we're talking about trading securities, we are the company that is purchasing stocks in another company. So if we purchase stocks in another company, they will pay us a dividend. When we are accounting for trading securities, you're just going to follow your basic debit credit rules. Whenever you purchase an investment, you're going to debit the investment, credit cash, and then if they pay a dividend, it's dividend revenue to you, so you're going to debit cash, credit dividend revenue for the amount of cash dividends that they pay you. But we'll take a more detailed look at this with an example in a few minutes. Now, this is something different that you have not seen before. That's one of the most important rules about trading securities. Trading securities are reported on the balance sheet at current fair market value. If you remember, all this time we report all our assets on historical cost basis. We follow our historical cost principle. However, trading securities are an exception. Trading securities can be sold immediately because there's always an open market for them. So GAAP says that we need to report trading securities on the balance sheet at current market value. If the market value has increased from the date that we had bought it, we show that we have an unrealized gain. The word unrealized means that we have not gotten it into our hand yet. We have not realized it, but it is a potential gain. Similarly, if a fair value has decreased over the time, we have an unrealized loss, which is a potential loss. And in accounting, we do record these unrealized gains and losses. This slide shows you the journal entries for adjusting trading securities to fair value. We're going to take a look at an example next. In this example, on July 2nd, 2012, we purchased 2,000 shares of common stock of GoLightly Inc. as a trading investment, paying $10 a share. On August 31st of 2012, we received a 50 cents per share dividend on the GoLightly stock. On December 31st, 2012, it is our year end, and we adjusted the GoLightly stock to its fair value of $11 a share. Then, March 1st of the following year, which is 2013, we sold the GoLightly stock for $11.50 per share. Let's take a look at how we would record these transactions in our books. On July 2nd, on the date of purchase, We purchased 2,000 shares for $10 a share. That means we would have paid $20,000, which is 2,000 times $10. We paid $20,000 cash because the stock market does not let us pay anything other than cash to purchase shares. So what we would do on that date is debit our short-term investment account in Go Lightly and credit cash for $20,000. So again, the journal entry on the date of purchase would be to debit your short-term investment for the amount that you paid and credit cash. That takes care of that first transaction. Next, let's take a look at the August 31st, 2012 transaction. We received a 50-cent per share dividend on the Go Lightly stock. Whenever our company that we invested in pays us dividends, that becomes dividend revenue to us. So we're going to have another T account that we call dividend revenue. You know that T accounts are ledger accounts. Now the next problem is how much of a dividend did we receive? They paid 50 cents per share and we had 2,000 shares. So the dividend we would have received would be $1,000. For that $1,000, we would debit cash and credit dividend revenue. Remember, cash is an asset. Cash went up by 1,000, so we debit cash. Revenues are credits. Dividend revenue went up by 1,000. We credited revenues. That takes care of the August 31st transaction. Now, the next thing is it is our year end. At year end, we adjusted the Go Lightly stock to its fair value of $11 a share. Now, you know that trading securities, which this is a trading security, are reported on the balance sheet at its fair market value. We bought the shares for $10 a share, but on December 31st, they are valued at $11 a share, which means we have to report it on our balance sheet at $11 a share. You know that we report our ending balances on our ledgers in our balance sheet. So our short-term investment in Go Lightly should have an ending balance of $22,000. How did we get $22,000? It's $11 a share times the 2,000 shares we had. So we have to adjust our short-term investment in Go Lightly to reflect a $22,000 ending balance. We had 20, it went up to 22. What adjusting entry do we need to do? You all know that to bring the ending balance up to 22, we would debit our short-term investment in Go Lightly for $2,000. But the account that we credit is a new account. We call it an unrealized gain account, and we would credit the unrealized gain account by $2,000. Now, why is this a gain? It's because your current value is $22,000 and you bought it for $2,000, so you had an unrealized gain of $2,000. Why it's unrealized? Because you have not sold it yet. Why are we showing it here? It's because GAAP tells us that we have to. The unrealized gain is $2,000 and it is always on the credit side. So I'm going to give you a new accounting rule because you have not seen gains and losses before. The rule for gains and losses is if it is a gain, treat it just like a revenue. If it is a loss, treat it just like an expense. So you know that revenues are increased by credits. Gains are also increased by credits. So our gain went up by $2,000. So we credited our unrealized gain account for $2,000. It is the year end, so we do have to prepare our financial statements. And you have to know what items go where on the financial statements. Your short-term investment is an asset. It's a current asset, so it is a permanent account and it will go on your balance sheet. So will your cash, that's right here. Now you know revenues are going in your income statement. Revenues and expenses go on your income statement. Now you've got this new item here, which is a gain. Gains and losses also appear on your income statement. So now You know that not only do revenues and expenses, but gains and losses also appear on your income statement. Let's go take a look at how they are presented. So now we said your short-term investment is shown at the fair market value in your balance sheet. The ending balance of our short-term investment was $22,000, and that will be shown in your current assets. See how cash is shown first, and then short-term investments at fair value, and then accounts receivable. Short-term investments is the second most liquid asset compared to cash. The other items we talked about would go in our income statement. Earlier, we said revenues minus expenses is net income, but after you list your expenses, you have another section in your income statement that's described as other revenue, gains, and losses. Under that, you would have any interest revenue if you had any. The dividend revenue, $1,000, would also be shown here under our other revenues, gains, and losses. And then the unrealized gain on investment would also be shown here. You would add those two items to whatever you had up here to come up with your net income. Remember, if it's an unrealized loss, this would be shown in parentheses or as a negative amount. And then you would subtract it to get your net income. One more thing before we move on. The short-term investment at fair value, the amount listed on the balance sheet, is called the carrying amount. So there is a term for that. We call this amount the carrying amount of the investment. Now we talked about unrealized gains and losses, but we do have realized gains and losses when we sell that investment. Again, realized gains and losses are only reported when the investment is sold. The gain or loss on selling is calculated not based on our original price, not based on our original purchase price, but it is based on the carrying amount. So if the sales price is greater than the carrying amount, you have a gain. If the sales price is less than the carrying amount, you have a loss. As we talked about a minute ago, the carrying amount is the amount that you listed on your balance sheet, the fair market value at the end of the year. Let's continue with the same example. Now we are on March 31st, 2013 transaction. We sold the Golightly stock for $11.50 per share. You know that your carrying amount of your short-term investment was $22,000. Now we're going to be selling that investment, and we're going to sell it for $11.50 per share. You know that when we sell an investment, we receive cash. How much cash do we receive? We receive $11.50 per share times 2,000 shares, a total of $23,000. So our cash increases by $23,000, so we are going to debit cash for $23,000. Remember, for all transactions, you have to have an equal opposite reaction. So we got $23,000, we need $23,000 on the credit side. We have sold our short-term investments in Golightly, so we do not have that investment anymore in our books. So we credit $22,000. Now the balance on our short-term investment account is zero. We're still not done because all our debits are not equal to our credits. The third account involved when we sell an investment is the gain, the realized gain or loss. So now, is this a gain or a loss? Well, we sold it for $23,000. The carrying value was $22,000, so our selling price is more than our carrying value. Therefore, we have a gain. It is a gain on sale of investment. It's a realized gain of $1,000. Even though it's a realized gain, we do not call that account a realized gain. It's just called a gain on sale. So whenever you see a gain, you know that it's a realized gain. If it is unrealized in accounting, it would be clearly labeled as an unrealized gain. Now let's see if our debits and credits are equal. We debited $23,000 cash for our selling price. We credited $22,000 and zeroed out our investment account. and then we credited 1,000, which is a gain on sale. Our debits are equal to our credits, so we are done recording this transaction. This gain on sale will be shown in other gains, revenues, and losses in your income statement for the year ended 2013. Just remember, whenever you're calculating the gain on sale, you're always going to be looking at the difference between your carrying amount and your selling price. If your carrying amount is greater than your selling price, then you would have an account called loss on sale, and loss on sale would be shown on the debit side. Remember, gains are just like revenues, they will be shown on the credit side. Losses are just like expenses, they will be shown on the debit side of your ledger account.